Hello, welcome back to BWS for weekly recap and preview.
The March CPI data is out, hitting a nearly 4-year high, yet it failed to drag down the U.S. stock market. The Nasdaq rose 0.54%, led by resilient tech stocks, while financials took a hit. With Powell serving pro tempore until Warsh is confirmed, how will the Fed navigate rising oil prices and persistent inflation?
High valuations are still looming. Is this relief rally built to last? Geopolitical easing has given the market some room to breathe, but deep divisions in negotiations mean energy pressure remains. Jobless claims show resilience, and within the Mag 7, Nvidia remains strong while Microsoft lags behind. The big question remains, is this the start of a real rebound, or just a final cushion at the peak?
Let's look at the data. The S&P 500 stands at 6,835.22, up 0.15%. Nasdaq at 22,946. VIX is around 19.23. The Fed's target rate remains at 3.5 to 3.75%, with CME probabilities holding steady. Unemployment is at 4.3%, and while CPI is driven by energy, PCE is expected at 2.7%.
The Shiller PE remains extremely elevated, with credit spreads at 2.94. Looking ahead, if negotiations show positive progress and oil prices stay cool, risk assets could drift higher, with tech continuing to lead. However, high valuations combined with this policy transition remain the biggest risks.
My take? Optimistically, with a ceasefire and Fed continuity, the S&P could gain another 5 to 7%. Pessimistically, stalled talks or a resurfacing inflation spike could trigger a 6 to 10% pullback. Long-term, AI and policy shifts remain the core themes, but expect significantly higher volatility. Don't be too aggressive right now.
Bottom line, we have a breather, but the crisis signals haven't faded. High valuations in geopolitics will dictate the next move. Don't be fooled by today's small gains, stay prepared. Like this video and let me know, are we heading for a breakout or a breakdown?
We'll see you in the next deep dive. Do not forget to subscribe.